Let's turn our focus now to what investors should consider when altering their investments given the current economic climate. And this is high inflation is bringing increased levels of financial stress. Business development consultant at Morningstar Investments Management SA, Abigail Wilson, speaks to us about this. Thank you so much for your time, Abigail. It's definitely not a good time for any of our pockets. So what does it mean for investment, as some would be bailing out, and not that that would be the greatest advice to give at this stage?
Hi, Tumi-sang, and thanks so much for hosting me this morning. We are indeed in a time of very high market volatility, and year-to-date returns have been pretty bleak across the board. I mean, except if you were invested just in cash. And this is also coupled with high inflation. So investors often tend to focus more on bad news and they celebrate good news. And many are watching their investments with a very sharp eye at the moment, and they're wondering, should they be making changes? Some might even be tempted to move to cash, and that means that you're effectively locking in your losses if you're selling out of equities and bonds at the moment. So moving to cash during a market trough can be detrimental to long-term returns. And remember that with even though we're getting higher yields on offer on cash due to the increase in interest rates, cash is still a loser on an inflation-adjusted basis over the long run. So, I mean, the question is, should investors be making changes? And the answer is, if your goals haven't changed, then probably not. But you should chat with your financial advisor to make sure that your investment goals and objectives of the funds that you are invested in are aligned.
Absolutely important, but making those changes comes with complexities. Let's just talk about how tricky it is to navigate that space.
Certainly. I mean, if you are making changes, I mean, in terms of switching unit trusts or selling out of stocks, going into cash, you need to consider, for example, the capital gains tax that could come with that. There's a large array of products that are available to South African investors that you need to navigate before making these choices and make sure that the product is suited to your long-term objectives. So there's over 2,500 unit trusts available for sale in South Africa, and an investor might also consider bank deposits, retail savings bonds, a direct stock portfolio, or exchange-traded funds. And on top of this, they need to consider if they need a product wrapper to house their investments, such as an endowment or retirement annuity, a living annuity, or a tax-free savings product policy. And some of these wrappers can actually bring tax benefits and estate planning benefits. However, they also have rules in terms of when you can access the money. Yeah. So when you're trying to make changes, if you're in one of these wrappers, I mean, you might not be able to if you are still within your restricted period. For example, if you're in an endowment and it's within your first 5 years of the investment period, this is a restricted period. So there could be huge penalties if you make a change. If you're in a retirement annuity, you ideally cannot access those funds until retirement age, such as minimum age 55. So you could switch from one retirement annuity to another, but you can't switch out of it unless, for example, you're immigrating, and there would be quite large tax consequences there as well. So at a time like this, we also want to encourage investors to try and avoid performance chasing, and that's, investing in yesterday's winners, which might be.
You're quite correct there when you talk about investing in yesterday's winners. And, of course, investing is a long-term game. And I'm interested in finding out how critical is it then for one to have some sort of a checklist and, measure your investment based on when you started, what your goals are, and where you stand currently, irrespective of the current tough economic times globally. It's also quite important to measure that risk is one that remains within market activity, but it doesn't last forever.
Correct, yes. So, sorry, I missed the beginning of what you were saying there, Tumi-sang. But yeah, essentially, it's very important to make sure that your risk and return are tied together with your investment objectives. So over the long run, if you're a long-term investor, you need to actually stomach risk to get those long-term returns. And a nice thing that we like to say is that investing is almost a string of highs and lows, and you need to sit through those highs sit through the lows, to receive the highs in the long run.
Thank you so much for that advice. That's Abigail Wilson from Morningstar Investments this morning on the business desk, talking to us about the tricky trajectory within investment in the current economic climate.